You're tuning into the Real Estate Diversification Podcast, hosted by trusted and experienced real estate attorneys who are also seasoned real estate investors themselves. Are you ready to explore unique real estate investing opportunities? Ready to learn about emerging trends and new ideas? Your hosts will help you understand the practical and legal complexities of a myriad of real estate investments so that you can maximize your potential and achieve financial freedom. Now, listen in and get ready to learn.
Hi, everyone. Welcome to the Red Podcast. My name is Douglas Rainey. I'm a senior associate here at Kansas City Real Estate Law, and I'm going to talk a little bit about oil and gas investing. So my family has been involved with oil and gas my entire life. I've been around it quite a bit, and quite often we'll hear from people who are interested in investing in oil and gas, just aren't sure how to go about that. So my advice is, if you're interested in investing in oil, is to consider just kind of a publicly available option. You can always invest in a publicly traded company. You can buy oil futures. So if for whatever reason you think the market doesn't quite reflect the value of oil, that's the easiest way to go, is just to kind of look into some of those publicly available options. Again, futures, options, things like that, or invest in publicly traded oil and gas companies. I'm going to spend most of my time talking about some options for investing in oil and gas that aren't as publicly available. Maybe you have an opportunity that comes across your desk and you're not really sure how to proceed. So in general, when considering oil and gas, with a smaller independent company or operator, it's going to be significantly higher risk than most investments out there. So I'll get into all of those in a little bit more detail, but in general, I would say you're going to want to be more prepared to lose your entire investment in oil and gas than you might be in some other types of investment. Of course, the flip side to that is your returns tend to be higher. So I would put the risk level at generally lower than if you're buying a stake in a startup, very early stage startup, but considerably higher level of risk than it would be a safer investment, such as buying into a multifamily housing complex that already exists and is already generating steady revenue. So on that note, I'll start by talking a little bit about what's called an override or a royalty interest. Generally, these are interest in an oil and gas lease that isn't required to participate in the expenses. So generally the landowners are going to get a royalty interest, or at least the mineral rights owner. Sometimes the landowner, sometimes isn't, or somebody else will get an override interest when a lease is created. These are highly desirable. It's probably unlikely you're going to have the opportunity to buy into one of these if you don't have any connections to oil and gas. Even if you do have that opportunity, you're going to want to have some sort of connection to the lease to put a dollar value on those. You want to get a general sense of what the lease is producing and what is likely to produce in the future before you can value those. But in general, those are your most desirable assets, just because let's say you have a 87.5% lease. That means what's called a working interest that has to participate in the expenses of the lease is only getting 87.5% of the revenues. The other 12.5%, you're going to be going to the royalty and override interest owners. Often it's considerably lower than 87.5, can be as low as 80, even lower than that. And it's all negotiable when you create the lease. But in general, if you can have an ownership interest where you're participating in the revenues but not participating in the expenses, that's good to have. Of course, that's going to have a lot lower cap rate, than you'd find in other oil and gas investments, just because they're a lot safer. So, if you do have an opportunity to invest in one of those, the operator of the lease, who for whatever reason doesn't have the money to purchase that, and maybe they're willing to work something out with you where you'll put up the money and they'll get some piece of it and you'll get the majority of the override interest. It is a very generally good asset to have. So that's how those work. I'd say moving up the risk level in oil and gas is going to be a working interest in existing production. So, that generally means that the lease has already been created. The lease is held by existing commercially marketable production, but for whatever reason, it's available for sale. Maybe the existing owner is looking at retirement. They want a lump sum of money versus the more monthly income that the working interest provides. Maybe there's a bankruptcy involved, maybe there's a divorce involved, something like that. But those are certainly questions you're going to want to ask is, why is this available? Generally, if this is on your plate and you're not already an oil and gas operator, you might have an operator coming to you saying, hey, here's my business plan. Here's this production that I think we should buy. Generally, they're going to operate it for, some piece of the lease and, possibly some other compensation. But if you're offered, some or all of working interest for sale, you want to be asking questions like that. Kind of want to know why it's available, who's the operator, what are the operator's qualifications, and you want to know the plan, because there's going to be the upfront cost of acquiring a lease from the current lease owners. But that's not going to be the only expense involved. So you want to make sure you don't kind of get caught up in some drip pricing where you're putting up all this money up front only to find out there's even more money to put up later that you weren't expecting. So make sure that whoever's offering this investment to you has a detailed business plan, pro forma, projected revenues, projected expenses. You want to understand all of those before you sign any sort of operating agreement or anything like that. Is figure out exactly what you're buying and what the future expenses are likely to be. Because again, maybe the existing wells need a lot of work. Maybe they're likely to work later. That's generally part of the deal. So, make sure that, the general partner or the operator who's bringing this detail has done their due diligence to make sure that they're not, buying a lot more expenses than they might understand. Also, as far as the business plan goes, you want to know, are there any other drilling locations in the future? So generally your lease is going to be for a given number of acres and, has some producing wells on it right now, but maybe there's some more possible drilling locations later. We'll talk a little bit more about drilling in a second, but, if what you're buying is based on existing production, you want to talk to that operator and know that, we're going to be drilling into future wells and look at the operating agreement. Does the operator have unilateral discretion to drill and make capital calls where, you'd be on the hook for, some of those costs? So that's something you're going to want to insist is in the operating agreement is have all those potential expenses down the road clearly defined. So you're not taking on a much bigger commitment than you think you are. But getting to the point of drilling, so this can either be its own type of investment or it can be, in conjunction with existing production. But, in general, if you have a lease with no current production, it's going to be higher risk than if you're buying a lease with existing production that might have some additional drilling locations. Of course, like anything else, when you buy that riskier investment, you hope your upside is going to be higher. Sometimes you'll get a lease with no existing production. You'll drill a couple wells, and if you hit them, you might get all your money back in your first year, and you have a really good investment. That's less likely to happen if you're buying into a lease that already has, 8 producing wells already on it. You're lucky to have any additional drilling locations, and if you do, when those reserves are already proved out, it's going to be reflected in the price of the lease, more often than not. So that is the upside to buying into a deal where you're going to be drilling wells on a lease that currently doesn't have any existing production. Is generally the price is going to be a lot lower. Sometimes you can tie up that acreage in a lease without any upfront money, and the mineral rights owner, often but not always the landowner, their only compensation is going to be that royalty interest, where if you don't hit a well, they don't make anything. There's been more and more competition for that recently, so it's become less common to see those types of deals. Generally, the landowner is going to get some sort of money per acre on top of their royalty interest, but that's all negotiable in advance. But at any rate, same principles before. You want to see the exact business plan going in, and it's going to be really hard to project revenues just because it's a big question whether you're going to hit a producing well or not, and if you do, how much it's going to make. I think the biggest thing is to have your operator give you a good reason why they want to drill in this lease in the first place. And, two, equally as importantly, at least, is get a really good sense of what the potential expenses are. I would say that drilling a new well is not a risk I would take on by yourself if you're new to this industry. If you have the operator says, hey, I want to drill a well on this lease, you want to pay for it. Just because drilling a well costing the ballpark of $150,000, completing it costing the ballpark of $250,000. Generally, you're not going to complete unless you get some good news from the drill, but it's also very possible that you'll get enough positive news from your drilling that you'll complete it. And then once you commit the money to complete it, then you find out for one of a number of reasons that you're not going to have a viable well, in which case you can be out north of $400,000 and have nothing but a liability to show for it. You still have environmental obligations to the state, to spend money on plugging the well, et cetera. So it can be a pretty expensive proposition to get involved in drilling new wells. So I would say if it's something that interests you, get your feet wet, it'd probably be ideal to be a minority investor and not take on the entire project, and you can kind of learn about it that way. But again, don't be afraid to ask questions in advance before sign anything that kind of clearly define what's the plan, what's the operator's authority in terms of how much money to spend on drilling and so forth. What's the operator's compensation going to be? You want to fully understand all of that before you get too involved. That is probably my main takeaway from all of this, is just always review your operating agreements and the pro forma presented to you before agreeing to anything. Don't get too fired up about the prospect of making a lot of money without kind of taking a deep breath and doing your due diligence, looking into all of this. Definitely would recommend having an attorney review any agreement put in front of you, just to make sure the terms are reasonable and reflect your understanding of the deal as it was pitched to you. And ideally, you'd have someone, a neutral third party, kind of review the actual nuts and bolts of the deal, the surrounding acreage, basically kind of figure out why that you'd be getting involved with this particular deal. And then title work, same thing. Make sure that before you put up any money and commit to anything, the individual or entity from whom you're buying the lease or leasing the mineral rights actually has title to lease that to you. Sometimes there's kind of wrinkles in that can cause a lot of problems down the road. So you want to make sure you have those resolved before you commit a significant amount of money to get involved. So again, that's just kind of a basic overview of investing in oil and gas. Let me know if any of you have any questions about it. Thank you.
Thanks for listening to the Real Estate Diversification Podcast. Did you enjoy the episode? Visit www.rediversification.com to tune in to more exciting episodes and free information and tools that will help you succeed. Leave us a review and subscribe to us on Apple Podcasts and our other social media channels at the RED Podcast. Thank you for listening, and we'll see you next time. Missouri Bar Advertising Disclosure. Neither the Supreme Court of Missouri nor the Missouri Bar reviews nor approves certifying organizations or specialist designations. The choice of a lawyer is an important decision and should not be based solely upon advertisements.